Welcome to Training the Newbie, the podcast where we explore what happens when two worlds collide. I'm your host, Bill, and in this series, I'm taking on a bold challenge, training someone from the halls of academia, a professor with a rich background in leadership and entrepreneurship, to navigate the fast-paced, high-stakes world of Forex trading. It's a journey of transformation, uncertainty and insight, where theory meets practice and strategy meets screen time. Whether you're a teacher, an artist, a coder, or just someone who's curious about making your money work smarter, this show is for you, because if a seasoned academic can step into the Forex arena and learn to read the markets like a pro, why not you? Let's dive in. So what we're going to talk about today is the fun stuff, actually trading. Let me share this. Can you see that screen okay?
Yep.
All right, cool. Trading style, this is a personal decision on your part, how you want to do this. And I thought I'd go through a bunch of different styles and explain what they are. And then you can chew on that for a little while and see which one you're most interested in. I have some examples of some indicators that are available for free in TradingView that you can play with and use. Today, we're going to just talk about the different styles. Next week, we'll get into the tactical stuff of how do you set up your software and what do you want to trade and timeframes and all that good stuff. So there's a wide variety of methods that people use, but these are I think the biggies that everybody is familiar with, and a lot of people use these things to trade. I guess the only word of advice I would have is the simpler you design a strategy, I think is better. I find myself when I was going through this whole process, I listened to too much noise. I don't know how to explain it. There's so much information out, and to figure out how to decipher it is part of the challenge. But I ended up with two systems, one for scalping, which is basically trying to get little bits of profit frequently in a specified time, and another strategy that's more what I would call swing trading over a longer period of time, larger time frame kind of thing. Sometimes I'm in those trades for a day or two before they bear fruit or get stopped out. Trend following is probably the one that most people hear about. I'm going to show you my TradingView screen here. There is a indicator here called, where is my trend following one? Resistance, auto trend line, that's it. So what this indicator does is it basically just draws one line on here, and it shows you the trend in which the price is going. So the strategy then is to simply follow the trend, right? So you could pick a point somewhere in here. Usually the smarter place to get in on a trend, if it's going up, is at one of the lows of the trend, and then just get in and stay in until the trend is broken. So you could capture quite a bit of profit. This is a 15-minute chart. So it's pretty simple. So if you were following this trend down here, let's say you got in up here at this high, so your entry would be somewhere around there. You would probably exit this trade either right here or somewhere in this neighborhood, depending on the heat of battle. It's really easy to pick this stuff when it's a static chart and stuff isn't happening all the time. It may have lingered here for a couple of hours before it bounced off, and what could have happened is you got out of the trade and then it continued to go down, and then that screws with your head, right?
Kind of like what just happened to the left of the USD.
Yeah, exactly. But that is the crux of a trend following strategy. This is something that, do I have a moving average one? I think I have a moving average one in here. I'll save it for that. But when you see a lot of those reports on the financial channels, a lot of those analysts, this is all they're really doing. They're not doing anything convoluted or complicated. There was a really good book called The Turtle Traders, and it was a bunch of successful traders in the 80s basically made a bet that they could teach anyone how to trade. the crux of their strategy was a trend following strategy. So they gave a basic formula of how you determine which way the trend is going. And then you would stay in the trade for a very long time, months, years, whatever, and then get some kind of a return. So they interviewed a bunch of people. I got it down to a half dozen, gave them some money and went off and they did their thing. And they all had slightly different strategies on how to do it. And the guy with the trend following strategy was the one that won the bet. The next really popular strategy is range trading or support and resistance, right? So what that's all about is, let me bring this up. So price, a lot of people will say stuff like price has a memory and it remembers where it goes back to points in the past frequently. And if you keep track of those points, you can derive a strategy from that. The basic concept of support and resistance is if you know where those areas are at, you could build a strategy to exploit those. For example, here, price was going up, it hit an area of overhead resistance. You would place a trade to go short here and then follow it down. Now, if you were a very disciplined trader, when it reached this area of support, you would have exited the trade. There's a bunch of different ways you can do that. You can either get in over here and get out when it hits a support area, or you can get in here and then just have a stop loss that just follows the trade and stay in the trade until it breaches that point, which would maybe be like somewhere here. But once again, very easy to spot on a static chart, very hard to do in real life. Okay. Because your mind just starts going crazy. You just start thinking of all the possible outcomes of this. That's why I said when I do this, I literally set it and forget it. I walk away because
Yep.
you know I'll start thinking and change my mind. And you end up losing money once your brain starts taking over and you start imagining all these things that might happen. But that's the gist of it, right? Price goes down to an area of support. You would buy here and then you would stay in until it got to resistance again. So you try to capture this little chunk of movement right here, or this little chunk of movement right here from there to there. Okay. And remember, I said price only does one of three things. It either goes up, goes sideways, or goes down. So here it's going down, then it goes up, then it goes sideways for a while, goes down again, goes sideways for a long time, starts to go up again, kind of thing. So that's the essence of support and resistance trading. That's what Dave does. It's interesting because that's what he designed, that's what he's comfortable doing. But once you go through my training program, I give you my alerts for free. So you'll be getting those as notifications in Slack. He will compare my system entries and exits to his support and resistance charts that he has up on his screen. Usually, if they sync up frequently. So usually he will, if he's getting a signal to do something and my system is telling him to do the same thing, he usually will take that trade. So that's what support and resistance training is all about.
So, like, what's his reason for having picked this? Or is it just what you just said, which is that maybe he imagines it gives him an additional signal on top of yours, and that if they agree, a multi-model approach?
There's two parts to it. One, he doesn't need me, right? He can trade without me. He has his own system that he built. But comparing it to what my system is outputting with his strategy, he just gets that extra layer of comfort that he's made the right decision or he's going to make the right decision, kind of a thing.
But is it just trader comfort, or is there actual additional signal, do you think?
The problem you don't want to get into is the old analysis paralysis thing.
Right.
Some people put so much stuff on their charts that you can't figure out what the hell's going on.
Yep.
I find myself when I'm designing a system, I get to that point and I go, whoa, there's way too much crap. I got to take some stuff off, right? Because I'm getting too many things. And then if you start to use too many signals, they start to contradict each other. So then that really starts to confuse your mind. Because I just show you, like, see where these areas are of support and resistance. If all I got to do is change the time frame, and they're in completely different places. So you have to pick your time frame, pick your style, and stick with it. Next week, I'll show you how to run the paper trader so you can practice with a style or experiment with a bunch of different ones and figure out which one you like the best and try that. But that's the key. That's kind of the secret sauce. Figuring out a system you're really comfy with and staying with it,
Yep.
getting really good at it. There's this part of trading that I call sitting in the chair experience that you can't teach. You just have to literally put the time in. You will start to anticipate and be able to make very good guesses as to what price is going to do because you've seen it before. Okay. I can look at a chart with nothing on it, right? And I can identify areas of support and resistance as simple as saying, okay, that's a support area. This is a resistance area. My son, when I taught him how to trade, he probably summarized it the best. He goes, so Dad, you're looking for the pointy places, right? And I said, yeah, that's pretty much it, right? So wherever price is poking out, those are areas of support and resistance, right? So that makes it easy for you to trade. Now, classically, people trade support and resistance where you wait for it to get to someplace and then you trade in the opposite direction. But there are people who trade the breakouts of those areas. So an alternative way to trade this would be once it's broken out above resistance and closed above resistance, you would go long. So they might be trying to catch this little piece, right? Or they were waiting for it to come down to support. And then when it closed under support, they went short. And here they were able to catch a really big chunk, right? So it's really fluid, is the way I want to describe it. It has to be something that you've internalized. Because until you get to that point, you're just going to keep running around in circles and getting very frustrated because you don't stick to anything long enough to let it succeed. The power of big numbers, the probability thing we talked about a couple weeks.
Yep.
All right, so that's support and resistance. The next one that I have here is breakout trading. Okay, so this is exactly what I was just talking about. You're looking for areas of support and resistance and trading the breakouts. This is a little indicator that sort of identifies those areas, puts a little blue arrow there for you, and you would go short here, right? And then you would catch that little chunk there where you would go short here, you go long here, you go long here, et cetera, et cetera. So that's just another way of doing a thing. This is really hard to trade when it's going sideways. I'll put it this way, everybody's a genius in a trend. How's that sound?
Yeah, that's what I've
Uh,
been thinking too. That
if you can come up with something that's pretty accurate at identifying when price is going sideways and then just stay out until something happens, you'll be much more successful. That's probably the biggest thing people struggle with when they first discover an indicator. They go, oh my God, look at this thing. I would have made so much money. I would have gone short here and I would have gone short here and I would have gone short here. But your mind filters out, oh yeah, I would have gone short here a couple of times and lost money. And this stuff will just chew your account up. Okay. And that also has a lot to do with the time frame that you're trading in. So if I go to a 1 minute chart, these things are happening more frequently and traveling less distance. So that'll screw you up too. So you got to pick a time frame that you're comfy, that you like, that fits in with your lifestyle, et cetera, and move from there. The next style that I wanted to show you was moving averages. This is a combination of scalping and mean reversion. So scalping would be when price has moved below a certain moving average and then crossed back above it, or crossed above it and then crossed back down below it, you would try to capture this little chunk of price movement right here.
so this is are these standard deviations off the yellow or
These are simple moving averages.
no, but what are all the different lines?
They're just different moving averages. Let me see if I can show you. If I go in here on the settings, no, he doesn't have them identified.
Oh, like 1 day, 2 day, different time frame moving average.
Different time frames of the moving average. So one might be a 14, and they use the term period. So different periods of moving average. So like when you're watching CNBC, right? Or the financial channels, they'll say, let's say this was the 200 period moving average, right? So they'll say, as long as Apple Computer is above the 200 moving average, you should hang on to that stock, right? But if it breaks below it, that is the time when you want to get rid of that stock and wait for it to come back above the line before you get back in. So what people are trying to do is to time their trades to capture the most amount of profit that they possibly can. If you're doing a mean reversion strategy, when price goes down to the lower moving averages, you go long and you take it until it comes back to the mean, which is the middle, right? So you're trying to capture that little chunk, you're trying to capture this little chunk of movement, etc., going forward. That make sense?
Yeah. Is this the mean reversion strategy or
Well,
moving average?
this chart is a little confusing because it's a combination of the two. You can trade it as a mean reversion strategy by going short here when it hits the outside bands and riding it short until it hits the middle, or you could go long when it hits the lower bands and ride it up to the middle, which is the mean. Okay.
The longer term period mean.
Correct. Or you could just scalp. So as soon as it crosses one of the lines, you just get on and maybe you want to capture this little tiny chunk right here. Okay. So you're just trying to catch 5 or 10 pips from here to here,
Yeah.
kind of thing. So that's scalping. And then mean reversion is you're trying to get a outside band and ride it right back to the middle and get out when it's in the middle. So that's two strategies in one in this chart. Make sense?
Yep.
Okay. All right. So we've covered range trading, we've covered breakout trading, scalping, mean reversion, structure. Okay, structure is a little more complicated, but let me see if I can make it simple. So structure, and all this guy has are the arrows as to when to get in and out. Does he have anything else in there I can turn on? No. So the idea of structure is the way most trends are defined is if price is making higher highs and higher lows, that's a trend. So here, higher high, higher high, higher low. That's how you define the trend going upwards. That's why his signal is right here. Okay. And it's
But why is that signal there? Because he obviously doesn't have the future. So why is it there?
because classically, when a trend is forming, price is making higher highs and higher lows.
Oh, so like you're saying, like in the zoom in there from that point of support, you know,
Correct. If I zoom in, what I'm doing is, so I have a low here, and then I have a higher high here.
no, but like the indicator would go there right before that future plays out to the.
Correct. He's probably looking backwards here, and he's saying, okay, this high is a little higher than that high.
Yeah,
This
that's what
high
I
is a
mean.
little
Yeah.
higher than that high. This low is a little higher than this.
So like the first indication of higher highs, what he's marketing.
And that's what, if I looked at his code, that's what he's looking for, are those higher highs and higher lows. And it's exactly the opposite in reverse. So it's like lower highs, lower lows.
Yeah. What you're showing me there is what happened in the future.
Yeah, yeah, you're right. See, now I understand what you're asking me. So if I look right here,
Yeah.
lower high, lower low, lower.
Are you an active trader looking to elevate your trading skills? We invite you to join the Trade Faction, a community where you can witness trades called out live. To connect with fellow traders and gain real-time insights, simply click the link in the description or scan the QR code to join our free Slack channel. This is a great opportunity to enhance your trading strategies and stay ahead of the market. Also, don't forget to download our new Forex AI Sage app in the Apple App Store to use the latest in agentic AI to help you trade. So what are you waiting for? Click that link or scan the QR code now and download the app today.
Low, okay. And you pick like how many of those you got to see before you make a decision, right?
Yep.
So he might say 2 or 3 of those, and then I'm going to take a bet. The thing that it's going to keep
Yep.
going in that direction. And as long as it keeps going in that direction, then you have an opportunity to make money. Okay. And then he's got a little indicator here on the right that says it's bullish. So right now, he's looked at this little chunk of pricing And he's decided that he's getting higher highs and higher lows. So he's going to get in right there.
Yep.
Okay.
And then, so go show me one of the place above the D where it seems to be a little confused. Right now to the right of the D.
Oh,
Yeah,
here?
right there. Yeah.
Okay. So if I zoom in there, let's see what's going on.
Because it seems to be a little, it's like that sequencing of say 3 in a row is happening rapidly in different directions. So this is like where this strategy would have a risk, right?
Correct. Correct. So here, what he's doing is low, higher low, higher low, higher high, higher high. So it looks like he's only looking for two before he takes a bet.
Yeah. And maybe the way to improve this then is not looking at this, and I don't know, I have to look at a lot more, but what I'm seeing here, where the red indicator is a period of this lateral sideways shifting. And so maybe if there's a lateral move, I don't know if that would be a reason to maybe change his formula or something, like to be skeptical of the.
Sure. See, now you're starting to think. It's dangerous. Okay, so what he's doing here is high, high, lower low. So
Yeah.
then he's okay, there's two, let's go.
Yep.
But it's wrong. That's the mind bender of trading. You have to have a strategy for when you're wrong, because you're going to be wrong. That's the flaw that most people get into when they start to learn how to trade. They think these things are infallible and they're not. They just literally work at the laws of probability. But the way you win at it is you have to have a way to protect yourself. So what I would do if I was trading this strategy is once I entered this trade, I'd put my stop loss right here. So as soon as price crosses that line, I'm out of the trade.
You mean for the long trade?
If I had gotten into the short here, I would have put my stop loss. So as soon as price exceeded that line, I'm out of the trade. And then I got another signal here. So I would just jump on that one right away. That's really hard for people to do. Once they've entered in on something they thought was going to happen and it didn't, and then you get another one and it's in the other direction, this is the part where I said people have trouble pushing the button again.
Yeah.
But if you just do it, you will be successful over the long run. It's easy to talk about, it's hard to do.
Yeah. So in these, there's that other one to the left after the long bull run there.
Right?
Yeah, right there.
Okay.
So he has that other real rapid negative positive indicator.
Correct.
And so what you're saying is, again, for the probability's sake, like just keep pushing the button each time and then let your stop losses protect you.
Correct.
And then because this only happens 3 times in this chart, then
you'll be fine. Exactly. So the money you lost here, you'll make up here.
Yeah.
But what happens is for a lot of people, they'll do this. They've lost some money. Then this one comes along and they're like, I don't want to lose any more money. And then they don't take it. And then this thing happens. And then they're like, oh, shit, it just took off. Yeah, that's structure. If I show you my system for structure, it's a little easier to understand. So what I do, this is telling me right now that price is going sideways because I have my algorithms detect which way the trend is going. This has just been a breakout of overhead resistance. So you would go long here on this trade. I use two filters a lot. One is volume and the other one is the relative strength of the trade. They're two different math formulas. Volume is easy. I actually have it on the chart here. If I turn volume on, right now my filter is saying don't take this trade. That's what the big X means because volume is really low. Okay. So even though I'm breaking above resistance, stay out of this trade because there's not enough oomph in it to keep it going. So you may get a couple of pips out of this, but it's probably going to collapse and go down. Whereas when there's a great deal of volume, see if I can find it. It doesn't paint the old ones. I don't have it paint the old ones because I like to keep my charts really clean. If there was another one where there was a lot of volume, this would light up and this would turn green and it would say that it's okay to take that trade. And then this is just, for me, it's a far easier way to visualize what's going on. And I'll show you that on the simulator next week so you can actually see it do its thing. It's pretty fun and easy way to trade. So next up, this one is really interesting, and I do this occasionally. Where's my node? There's this method called grid trading. Okay, So grid trading is very much like dollar cost averaging. So the idea is I get in a trade and then I find these grid lines. I either use an indicator or I calculate them physically myself. In the old days, people used to do it on a piece of paper. The idea is, let's say I got in this trade here and then price collapsed down to here. I would buy more down at this lower level. And then if price collapsed down to here, I would buy even more because I know due to the laws of probability, at some point, price is going to reverse and go in the other direction. So even though I may be sitting on a pretty significant loss at this point, when price moves back in my direction, instead of one times what I was expecting to make, now I'm going to make three times. So price only needs to go past this point a little bit before you're making a lot of money. And there's a guy, I'll give you his YouTube videos. This is the way he trades. He uses a grid trading technique, and he literally does not use stop losses, but he has a ginormous account, okay? So that's the key is you have to have a large enough account to take the beatings when price is going against you, right? Same thing in the opposite direction. If I went short here and then price crept up to this grid line, I would go short some more here. And if it continued to creep up to here, I would add some more, knowing that eventually price is going to revert back to the mean. And then when it reverts back to the mean, that's when you get your losses back far quicker. Okay. And then once you've passed your break even point, you're making even more money. And actually, that's a good point to make is the more times I add to my position, the higher my break even point goes in. So if I add here more, my break even point is probably somewhere in here, right? It just has to get to there in order for me to break even. And if I add even more up here, my break even point might be somewhere over here. So it doesn't really have to go all the way back to where the price was. It just has to go to here, and anything past that line is profit.
Yep.
Okay. I call this waterfalling. Dave and I do this every once in a while. You'll get in a trade and it'll go against you. What do? I'll just waterfall it, and then I look for the next logical place to add more to the trade, and then hope that's the end of it. It's not going to keep going higher because then at some point you're going to run out of money. And then the risk of this kind of a strategy is you could end up having a huge loss or blow up your account
Hmm.
if it really rips against you. But if it goes in your favor, you make a lot of money. So that's also a little emotional mind game you have to play.
I remember this reminds me when I thought I was clever in college playing blackjack, and there was the same kind of approach, which I very promptly lost all the money I took to the casino once, where you're trying to play the probabilities, but of course, sometimes you do get streaks of 7 losses or whatever. The casino maxes out the size of your bet. There's different tables for blackjack that are like
Right.
$100, $1,000, whatever. And they manage the ratio between minimum and max, and then they prevent you from recouping in this kind of same way. And so I had, I don't know, first couple times, couple wins, whatever, feeling pretty good. But it was like in the first 20 minutes, I had a streak of 7 go against me and my whole amount was gone.
Yep.
Um,
That's what happens. That is the biggest risk of using this kind of strategy. My biggest losses have come from using this strategy. Also, my largest wins have come from this strategy.
Don't say that, Bill.
Yeah, it's just a personal choice. You have to decide which one you want to choose.
I'll be the mosquito of Wall Street. I'm just
Yeah,
gonna
exactly.
slowly take a little bit of blood every time.
But don't get caught in the bug zapper.
That's right.
So yeah, that's what that one's all about. And then the final one that I wanted to talk about is just trading news. There was this guy that I used to mentor with. I think he's still around. He lived in Lincolnshire or somewhere like that. This was his favorite strategy. So when news happens, there's usually a big spike in price. He'll do stuff like that. So what he would do, and I remember the first time I saw him do this, I was like, God, this is nuts. So what he would do is if a news event was about to happen, I'll show you a website that you can follow that you can tell when news is coming. Also, TradingView is really nice because it has these little indicators right here. The chart, that means there's news happening, and it tells you, it puts the little icon of what the currency pair is there. This is the dollar. This is the Canadian dollar. I can just tell by the little flag. So what
Yeah.
he would do is he would identify these points. And for him, this was like he would have a moving average in the middle, which was the mean. And then he would have standard deviations. I can't remember what he picked, if they were 2 or 3 standard deviations above that middle moving average. So he would place 2 orders on his chart. He would place a short up here, and he would place a long down here. And then when the news happened, more often than not, price would either spike down, catch his order, and then spin right back up. And he'd make a bunch of money in like seconds. He'd literally get in the trade, price would revert back to the mean very fast, and then he would get out immediately. I've seen him make hundreds of thousands of dollars in front of me doing this. And actually, if you think about the logic in it, it's not that risky because you are literally placing your trades at the biggest extremes of where price could move, at least mathematically speaking. Now, there's always going to be that time when it goes to here, you get long, and it just keeps going down or it keeps going up. So you have to have a parachute, right? You have to put a stop loss in there just in case, but still,
But in this case, it's assuming the assumption is that news will provoke an irrational pricing.
correct.
It's not going to be real value, but instead, on the news, people will overreact. They'll have a first inclination. Everyone will hit the button, and then someone will profit from that boost, and it'll bring it back to the consensus average.
Exactly. And you're just exploiting that. That's all you're doing. Okay. And that's all
So-
this guy did. And big news only happens maybe 2 or 3 times a week. So he would literally trade 10 minutes a week. And
Sounds nice.
he's making massive money doing this.
And would he do actually really trade the real thing, or would he do
Oh, yeah,
options?
here's the real thing.
No, I just mean like the real asset, whatever that is, versus options or derivatives for it.
He was trading stocks.
Oh, so like
He was
actual
trading,
all
yeah, he was
stock.
trading actual stocks.
So it must have been on major ETFs or something to be able to make hundreds of thousands of dollars. He was making,
Just a retail trader with a couple $1,000,000 in his account.
but that his size of his trade must have been like $1 million.
Depends on how much the thing moved. I'm honestly trying to remember the size of his trades. He might have 50,000 shares of something
Okay, yeah.
in that neighborhood. He was making 5 and 6 figure trades when he was doing this. But hey, if you can make 40 grand a week, what the hell? Nothing
Yeah.
wrong with that. I did see him make 6 figures several times on these
Wow.
trades. And he was an ex-cop.
Interesting.
So, yeah, it was weird. Like I said, some of the most successful people I've either taught or learned from came from very meager backgrounds,
Yeah,
not a lot
not
of
traditional.
education. Yeah. Yeah, it's almost like an asset as opposed to a deficit.
Yeah, I think it gets at knowing something more fundamental. Because again, like technical trading, as we talked about, is, I think I've now learned, a misnomer. It's really sentiment trading.
Correct.
And so if a cop would have a good sense of, oh, like when I see extreme behavior or like someone's blustering, basically, like it's not really them.
Yeah, it's all emotions. Those are the biggies that everybody wants to learn. Okay. That was what I wanted to cover today. The only other thing I wanted to show you was this website, and I'll put this link in where are that? This one right here. There's this website called Baby Pips. I don't know if you've discovered it yet or not. Hang on a second. Let me unshare and find it first.
So it's interesting. So many of these breakout trading, moving averages, trading news, etc. To me, maybe you can summarize them as they're all trading on these technical sentiment moves with the assumption that the moving average is the quote true value. It's like as it gets more divergent from the true value, that's an opportunity to enter a trade. And that there are these particular moments, either signals, indicators that you can get, or news that will prompt a divergence that then you can profit from the recalibration of the value back to the true value of the moving average.
The way I like to describe that is it's a piece of 2x4 with a nail in it and a rubber band attached to it. What happens is price gets stretched away from the nail, and then at some point it's going to let go and snap back, kind of thing. That's the essence of it, really. So if you can come up with strategies to figure out when that rubber band is getting stretched, those are the things that you want to leverage. Because if you think about it, even support and resistance, it's the same idea. A support area is where price has been stretched down very far. The rubber band has been stretched and it's going to bounce back up to the middle and maybe overshoot it and go up to the top, kind of a thing. This is a website. It's called the School of Pipsology, people refer to it. It's a free, there's a lot of minutia you need to learn as far as Forex trading is concerned. How do you trade it? Some of the stuff that I'm talking about in here is in this. A little bit about support and resistance, candlesticks, moving averages, all that kind of good stuff. And you can do this at your own pace. And I always show everybody this because it's a great reference tool as to what does this mean? Or some word will come up and you're like, what are they talking about? Although these days I can just pop it into Perplexity or something like that, and I get the answer back in seconds. When you want to spend a few minutes learning about something, you can go to Baby Pips, take their courses and a couple of modules. Or if there's a specific thing that you want to learn about, you can just click on that and learn about it. Here's one on trading the news. What's that one all about? So here we go. And shows you all this stuff.
Huh.
It's a great little
Yeah.
reference thing. That was all I wanted to cover with you today.